Coming up in today's video, stocks are higher here once again as the rebound continues. Ultimately, this dip that recently took place seems to have turned out to be a really good buying the dip opportunity. I've got my stop loss trailed just below this key action line that we've been talking about on the channel, and I do think that stocks can continue to rip into year's end and into 2026. This trade has very quickly become one of the best ones that I've had this whole year, and I do think that it has more room to run. I'm cautiously moving my stop loss to lock in profits on this position in case something changes. And just a few weeks ago, people were shouting that the AI crash was coming and that it was the end of times. And while I did not know with certainty that the market was going to go back up, at the end of the day, I am a trend follower. I don't try and predict when everything is going to come crumbling down like the perma bears of YouTube and Twitter and all that. Follow the trend, follow the macro, and have the humility to admit when you're wrong, and you'll do much better in markets than people who constantly call the top of the market, calling for crashes, and endlessly say that they think it's going to go to zero. The reality is the markets are bigger than any single one of us, and people who actually have the humility to just trend follow and not try and predict every little thing that's happening in the markets actually tend to do better anyways. I am by no means perfect in the markets. I've had many losing trades in front of a wide YouTube audience, but the thing that I rely on is following macro and price trends rather than trying to predict them. And the beauty of it is actually just by following trends, I've done better than trying to predict them. And here's a little preview for next year. Kevin Hassett, which is expected to be the next Fed chair, says it's time for the Fed to cautiously reduce rates. He mentions that the government shutdown had a bigger hit than expected, and there will be bigger rebound in the first quarter of next year. And just look at that face. That is the face of a man who wants to cut rates aggressively. And if there's one thing that stocks love, it's money printing, an injection of liquidity back into the markets through what could be potentially coming down the pipeline as well, which is tariff stimulus checks. Is that really coming back? We saw how that took place in 2021 and caused the market to melt up and to the right. And with a Fed chair who is likely to cut interest rates aggressively or as much as possible, the market, I think, can continue to rise as the Fed is very much on the side of the equities market for now. And this morning we had some interesting data from our northern neighbors. I've selected the Canadian unemployment rate here in the Edge Finder. We have employment data for a bunch of different major nations, and Canada actually had a really impressive drop in unemployment rate. Went from 6.9% down to 6.5%. By the way, the expectation was 7% unemployment rate for Canada, and we actually had a really nice drop in employment data. Now, you may not trade the Canadian dollar or the Canadian stock market, but this still matters to US data because, again, our economies, even with the tariff stuff going on, are still largely pretty connected and correlated to a certain degree. Good employment from Canada is in some ways a good sign of North America as a whole. The dollar CAD is lower here in response to this off of a stronger Canadian dollar. And we can go ahead and actually mark this as a supply zone now, as we've had a double top here kind of confirmed with this break to the downside that we're seeing today. Here's the Canadian dollar against the Japanese yen, firm here today and back towards those highs. And one of the worries of the market here recently has been the Bank of Japan, who is likely to hike interest rates this month and is open to more hikes. The Bank of Japan, however, has also said that they are aware of how Ueda, the governor of Bank of Japan, how his comments could be viewed. And they are aware that hiking interest rates could cause some problems globally and have sort of leaned into the idea of proceeding with caution, just like the US is talking about cutting interest rates cautiously. The Bank of Japan is talking about hiking interest rates cautiously. They don't want to disrupt the global system. They're not interested in doing that, but they do also see the need to hike interest rates more and more, it seems. And this morning we had the preliminary University of Michigan consumer sentiment, which actually came in really good. People have been really not feeling great about the economy, which, by the way, historically speaking, is usually a good indicator of the economy in a very weird way. When people feel really negative about the market, a lot of times that's a contrarian bullish signal. But we saw today, for the first time, a nice positive, upbeat read for consumer sentiment. Maybe people are feeling a little bit better nowadays. We did also see reports that Black Friday shopping was pretty dang strong here. Core PCE also came in this morning, pretty much in line with month-over-month expectations, and inflation expectations are at 4.1%. And precious metals are still on their grind to the upside here. I've got my stop loss trailed in this trade that I've been in for a couple weeks now. We've had a nice push to the upside. We've held support here, but I am looking for some follow through. So what I'm looking for here is a push through those highs, and any sort of higher low will give me an opportunity to continue to trail my stop loss, which was initially down here, has been trailed trailed into profit. I'm looking for any sort of higher low from here to continue to trail that stop further. If we're able to get through this high, I think we can constructively make that move back towards those all-time highs for gold, as momentum still seems to favor the bulls, and gold has had a phenomenal year this year. I mentioned recently in my videos that it's actually kept up with the S&P 500 over the last 30 years from like 1996, which is so impressive. From a monthly chart perspective, we've talked about this many times. People are kind of always calling this thing overbought, and it's just been, overbought for like so long now. It's been overbought for like a year. So clearly what that tells you is overbought doesn't necessarily really mean anything if the macro continues to support a very bullish outlook for gold. And two of the most important long-term reasons that I think gold is rising so dramatically is, number one, we have massive national debts rising internationally, like all over the world. Debt to GDP is skyrocketing. And this is concerning because as governments continue to print and borrow and borrow and borrow, what happens is the probabilities and the possibilities of that money getting repaid or those national debts, coming down relative to GDP gets more and more bleak and worrisome. National debt crisis is sort of like the ultimate bullish case for gold. If you were to have some sort of, we can't pay our national debt kind of scenario, gold would likely skyrocket. And I think gold has sort of been slowly sniffing this out over time with a lot of central banks buying gold aggressively. That tells me that there is some worry about, the status of the dollar, the status of other currencies, and the national debts rising globally are a concern to central banks and to many individuals as well. Additionally, we have interest rate cuts happening globally, which is just more money printing into the system and essentially very bullish for gold as well. And that's been a bullish tailwind for multiple years for gold that, at least for now, still seems to be very present. This is the issue sometimes with being a purely technical analyst or trader who only looks at charts. If you looked at this, you'd probably would have said a long time ago, this thing's overbought, needs to pull back on a bigger scale. But from a macro perspective, it makes sense. They keep printing dollars, but they can't keep printing gold. In fact, in my personal opinion, gold is still cheap on a longer term perspective, I should say. Here's a look at the US debt clock, $38 trillion, but I want to show you one specific indicator on here that I really like. The dollar to gold ratio right here, if I hover over this, check this out. So the US dollar to gold ratio, this is the year-over-year increase in the US M2 money supply divided by the yearly world production of gold in ounces. And when we zoom in on this right here, you can see the dollar to gold ratio is like $9,200 an ounce. If you have some sort of crisis around national debt, not saying that I think that will happen, but if it ever were to happen, I think a repricing in gold would send it to the moon. I want to reiterate that I'm not like super bearish and calling for a national debt crisis, but I do think it is always a possibility, and that is why I'm sort of always in the camp of, I like having a little gold in my portfolio. I also tend to trade it on the long side because I'm very bullish on it. I would much rather buy gold than store it in fiat cash that they keep printing. But I'm also bullish on corporations that are absolutely printing money, maybe even at a faster pace than the government. Not actually, the government is printing so much money, but in terms of locally, they are making a ton of money and significantly have, the stock market has significantly outpaced inflation over the last 20 years or so. Over time, stocks have been, at least historically speaking, one of the best hedges to inflation that there is. There's only one better, and that is starting a business that is profitable. But investing and holding companies that are doing well and growing at a pace that is much faster than inflation is why I also remain long-term sort of always bullish on stocks and looking for good deals. Now, I don't necessarily invest at the highs, and I don't personally think that the stock market is cheap by any nature, but from a trading perspective, I continue to be long on this thing. And interestingly, the latest commitment of traders data showed some institutional activity that was very bullish on the SPX, which is the S&P 500. Long contracts, they added significantly, and short contracts, they decreased significantly. And for those of you guys who are COT data trackers, if you use this stuff on a frequent basis, you may have noticed that there was some data that dropped earlier this week. Currently, we're getting double time in terms of commitment of traders data dropping because the government shutdown period, we are catching up. There's a backlog of reports that they're dropping 2 times per week currently. And the latest data will drop this afternoon. In fact, by the time you're watching this, new COT data might have actually dropped and populated within the Edge Finder. The Edge Finder makes it easy to track what institutional money is doing on your favorite assets, whether it be gold, the dollar, crypto, or even S&P 500, the COT data history tab makes it really easy to look over time at the direction that institutional money seems to be flowing. Interestingly, we've actually seen a recent trend of selling gold in institutional money positioning. Again, latest data will be coming out in just a few hours, and if you have an Edgefinder copy, head over to under institutional positioning, COT data history or COT data to read along with what the latest data is showing. And if you don't have a copy of Edgefinder, here's your last call. Our Cyber Monday deal, which we extended from this Monday to now, is currently coming to a close. It is our biggest discount that we do all year long for those interested in getting tools that can help better track things like institutional positioning, crowd sentiment or retail positioning, seasonality, and of course, macroeconomics that we talk about every day on this show. If you want these tools for yourself and your own trading analysis, then check them out down below in the description and take advantage of the discount that we are running this week. It is our biggest discount that we do all year long. To get 45% off the Edgefinder or our VIP group or the Stockbox, our other main software tool, scan the QR code that you see on your screen right now, and you'll be connected to a real person on our support staff who can set you up with a copy of the tool at a super discounted rate. And if you need a payment plan or to split up the cost, you can also discuss that with them. They'll be happy to set something up so that you don't miss the discounted prices and can split them up to a price level that is acceptable to your current budget. As I say always on my channel, I wouldn't sell something that I don't truly believe in and think it is worth every single penny. If you're looking to take your trading to the next level with tools that help you to do so, consider checking out the tools that we've built over the last few years. So just a bit of an update on the NASDAQ position that I took here. So I'm sitting in a pretty good position. We actually just were able to close above this level, or at least we're trying to close. I'm very curious to see how we close today. If we're able to close above this key area of resistance, I think we are looking really good for a push through those all-time highs. Now I use the long position tool on TradingView just to map out my trade, but I actually do not have any sort of take profit on this trade. If you've watched my channel for a while, then you probably are familiar with my trailing stop methodology. I use a really simple concept of using key market structure like we have here to trail my stop loss rather than use strict take profit levels. What this allows me to do is let a winner really run if I'm truly correct about something. So let me give you a hypothetical scenario of how I might manage this trade going forward. And by the way, I share all of these updates that I'm actually doing inside of our VIP Discord, which is also linked in the description. So let's just say that we get a really solid close above this. That would look excellent. I've got my stop loss trailed here behind this major area of what was resistance, right? That big sell-off in NVIDIA earnings day. We recaptured that area. And once we got head and shoulders above that, I moved my stop loss into profit. And at this point, the next move for me would be to look for another sort of higher low or break above a key zone of resistance. So if we can get something like this kind of move here, this looks excellent for an opportunity for me to take that stop loss and to further lock in some gains on this trade that I'm currently sitting in. What this allows me to do is not cap a winning trade. Meaning, if this thing wants to just melt up into the sunset, meaning for the rest of this year, we just make a thrust through the all-time high, I want to be there for it. I don't want to cap my winner because again, price momentum is a real thing. And if this thing wants to just push through those highs, what I'll do is, let's say at this point in time, what I may choose to do is trail that stop again. And let's say we get to this point in time, what I'll do is trail that stop again. What this allows me to do is be less predictive in my trading and more reactive to what markets are actually doing. I want to show you something on the US economic heat map as well. When looking at the US economic heat map, what we can see here is that a lot of our recent data has been actually coming in pretty promising. We had services PMI data that came in better than expected. We had initial jobless claims that came out this week, way better than expected. Non-farm payroll beat expectations by 66,000 jobs added, while a slight negative is that ADP numbers were pretty rough. Retail sales were also not that great, but GDP growth remains very strong. What this tool that you're looking at, the economic heat map, does is it looks at all this stuff and sort of builds a overall summary of what economic data recently has been showing. And this output, the macro score overall, is actually factored into the top setups algorithm for each and every dollar related or US related asset. So for example, the US dollar, the US stock market, gold, all of these things are impacted in their overall score within the Edgefinder by what you're looking at here on the US economic heat map. And so right now, the bias from Edgefinder is US stocks still look supported overall based on this economic data, which of course, nothing is perfect. You have your blemishes here, right? ADP, not so great. But again, I don't want to ignore the good stuff just because we have one bad thing. One of the biggest mistakes that I see macro traders do is they pick and choose what things they really care about looking at. And so what I mean by that is that if you're somebody who's really bearish, you'll say, well, ADP is horrible, but you'll ignore that NFP came in really good. Or for example, you'll say that, let's just say, for example, manufacturing PMIs, they missed expectations. They look negative. They missed by 0.8, right? But then you'll completely ignore that services PMIs actually came in way better. And by the way, services PMIs are the more important of these two, as the US is a much more services rather than manufacturing oriented economy. So instead of picking and choosing selectively, this is where systematic trading is so critical. We look at these core set of data points, and there's nothing that I can do with my narrative to look at this and say, oh, it's bearish or oh, it's bullish, right? We have a pre-coded algorithm that does not have feelings or emotions or biases. It simply showcases what we're looking at here and projects an overall summary. So with Edgefinder, you're scanning a ton of data that would be very hard to do manually. I used to do it, trust me, it was a really tedious process. I mean, that's why we automated and built these tools. But additionally, you are taking that information and you are having a system to punch out what it is overall projecting about the US economy at this time. And did you know you can actually get a copy of the Edgefinder for free with today's video sponsor, 8cap? 8cap has essentially offered to purchase copies of the Edgefinder on behalf of clients that are referred from our YouTube channel here. Now there is a catch, there's always a catch. You have to create and deposit an account using our link that exceeds a deposit threshold that I'll show you now. So basically 8cap is looking for new clients. And if you are interested in trading with 8cap, then, and you've done your due diligence, you decide, hey, that's a good brokerage for me, then it's a win-win-win. What I mean by that is you support our work by signing up with an affiliate who's sponsoring our content. I greatly appreciate if you choose to use our link. Second, 8cap gets a serious customer and a client to work with. And third, you get a great brokerage and free tools. So if you scroll down on this website, which I'll link below, a1trading.com/8cap, scroll down, and if you deposit these certain thresholds, you can see what 8cap will essentially gift you by purchasing it on your behalf. For more information on this, head over to a1trading.com/8cap and make sure to read the full disclaimer and rules attached to this on that page. Now back to the video. And if you trade currencies, you may also be looking at things like, the UK economic heat map or the EU, or maybe you want to look at all of those heat maps summarized. Check it out. You got your economic surprise meter, which will show you which currencies have been seeing some stronger than expected readings overall. The way to read this is currently the Australian dollar has had some really upbeat reports for the Australian dollar specifically. We could go over to the AU economic heat map to get a better picture, and what you can see here is that most of our metrics are positively impacting the Australian dollar currently. While GDP numbers came in soft for the Australian dollar, services PMIs, retail sales, inflation, PPI, unemployment rate, and employment change all came in a way that was bullish for the Australian dollar. What we just did right there was we completely automated most of the fundamental analysis steps that many traders wish they could do, and instead spend a lot of time reading and watching videos to try and get a feel for what the Australian dollar is going to do. In today's era, using software with your trading is not a want. I think it's kind of becoming a need. You have all the hedge funds and professional players at this table using proprietary behind closed doors tools, and my company A1 Trading, we're trying to build that caliber of stuff for the everyday retail trader. So there it is, your sales pitch on why you should get a copy of our tools. Support our mission. Get yourself some macroeconomic tools that really can help you to better analyze markets and support our work here on this YouTube channel. It is a great way, again, to level up your understanding of markets through our tools, as well as to scan them automatically and to take out some of the emotion involved of reading scary news headlines all the time. Turn off your CNN and your Fox.com or whatever and start focusing on just the data. I'll leave all the information down below. Last call on that, and see you next time.